Hello and welcome to yet another edition of Who Moved the Market. I am Surabhi Upadhyay. We are winding down the week and it's been a week of outsized moves. Remember, you heard us talk about this just on the show a couple of days back as well. Even yesterday we were discussing pharma stocks. Well, that trend continues and today we are going to focus on one specific stock from the consumer space that has the entire market watching it very, very carefully. I am talking about Page Industries. So what is the deal with Page? Well, the stock on Friday has been down throughout the session anywhere between 9, 10, 11%. The reason really is disappointment in the fourth quarter. So is it just a one-quarter miss? What is the issue? Is it a red flag overall on consumer sentiment? Or is there something specifically going wrong within the company, Page Industries? Well, to help me do that, we have with us Himanshu Nayyar. He's joining in from Systematix. Himanshu tracks the consumer space, a lot of companies within the sector on the staple side and on the discretionary side. So Himanshu, first of all, welcome to the show.
Yeah, hi. Thanks for having me here, Surabhi.
So I'm going to dive right in, Himanshu. With Page Industries, the expectations are always pretty tall, right? Considering the kind of lofty valuations that the stock has been always trading at. It has a lot of institutional ownership even now. So how would you describe the fourth quarter?
Yeah, so the point is expectations from Page have been very high given the historical run rate of 20% plus growth that we are used to seeing from the company. Currently, of course, things are weak on both fronts, externally as well as internally. So externally, demand has been quite sluggish in the apparel space. Plus, the base over the last couple of years was also quite high when they had seen very strong growth in the athleisure segment. The other issue was there was high amount of channel inventory across the board. So in any case, there were not very high expectations from this quarter. We were looking at a flattish sort of a performance on the growth revenue front from Page. But the big negative surprise came in with that 13% decline that they saw. And the major reason, apart from the market demand being sluggish and inventory being high, was this ARS implementation that they are undergoing since the last quarter. And there, I think the hit on sales because of that inventory correction exercise that is ongoing. There, I think the impact was much larger than what the street, including us, that we were expecting. So
Okay.
I think that has been the big negative surprise. I think margin weakness was also there, but that to a large extent was sort of known. It is slightly more than what we were building in, but that again is on account of negative operating leverage. If sales would have been normal, then margins would still have been in line because of the high cost cotton inventory that they were holding. So margins for sure, it looks like they have bottomed out. But yeah, the bigger concern out here is this sharp revenue decline and the fact that now it looks like it will continue for a couple more quarters.
Oh, you are expecting the revenue challenge to continue for some time. So let me break this up into two different parts. As Himanshu mentioned, there is something called ARS implementation. For the benefit of our viewers, this is auto replenishment system. Now, Himanshu, help us, demystify this. My understanding is basically they're implementing, a software system that's going to help in better inventory management. Which is great conceptually, but it seems to be really hurting them a lot. Most retail companies, and you track so many of them, right? I mean, most retail companies would have pretty smart inventory management systems. So what is about this ARS? And how patient do you think the market will be with something like this? Because at the end of the day, it's impacting the business negatively.
Yeah, so this I think this is a slightly peculiar case specifically for the innerwear industry. If you look at the domestic guys like Rupa, Dollar, Lux, they've also, I mean, see, historically innerwear has been a push-driven sort of a model where the companies produce what they think will sell, and then the distributors buy whatever is available without considering the fact that what will sell in the market. So Page is taking a lead here in terms of implementing a software using their customer analytics data, which will predict in every micro market what is going to sell, which SKUs are going to sell the most. So therefore, they take the purchase decision away from the distributor and the system decides it. So this as a system conceptually, of course, will help the distributors in liquidating the inventory in a faster manner. There will be lower losses in terms of SKU non-availability, etc. But that, of course, is a painful period in the near term because you have a lot of inventory sitting with the distributor at all points of time. And what you need, I mean, it will take time to sort of first liquidate the slow-moving inventory which the distributor has accumulated, and that is the painful process of almost a year, which the company is undergoing. 6 months are complete, and now they are saying that middle of 2Q FY24 is when they expect to complete this. And obviously, it's a massive exercise given Page has more than 4,800 odd distributors.
Oh, yeah. So they have to, get the system up and running and, get it throughout that distribution network that you just spoke of. Okay, so fair enough. There is this one, inventory management or upgradation exercise with respect to better software. We understand that. Let's come to the other side of the problem, demand itself. How much do you think this is just high base? I mean, nobody's buying, or most people aren't buying more at leisure now because we've all returned to office. That's one aspect, which perhaps could be transient. So as that base effect wears off, you get into a normalized path. Is that how you see it? Or is this a bigger concern that perhaps the price points at which, Page is retailing now, perhaps that's becoming a little inhibitive because of, in general, whether you say inflation, the consumer's wallet share, etc. So basically, is it a deeper demand issue or is it just a high base issue?
So I would say it's a combination of both. I mean, of course, base is high, which should surely correct as we go. I mean, a couple of quarters down the line, and of course, inflation has been quite high, so prices across products have moved up. But the good part, if you look at the numbers in detail, is the premium products are still doing relatively better than the mass or the economy products. So the customer at the upper end for a jockey product is still not really bothered about cutting his spends because the prices are high. So that is not too much of a challenge in my view. And historically, we have seen whenever these sharp price hikes happen, there is a couple of quarters of impact, and then people accept those prices as the new normal, and then things go on as usual. So that's the reason I believe it's of course we should not be expecting a 20% growth trajectory as we have seen in the past now, but at least a mid-teen sort of a growth should not be a challenge from the second half of this year. At least that's the base case in our view, unless something goes drastically wrong. Because structurally, it's not that they are losing market share or anything to any of the other larger guys. It's a sector specific issue, and the key reason in my view is customers with their spends increasing on a lot of other categories are maybe postponing their purchases
Yeah.
of Pages products, especially the in-home products, obviously, which I mean, which are slightly more discretionary
Yeah.
in nature.
No, absolutely. I guess the spends are more on outerwear now because we finally normalized post-COVID than innerwear, which, as you're saying, can be put off for some time. By the way, viewers, we didn't tell you, I mean, this company that we're discussing, Page Industries, in case you don't know it, this is the jockey franchise here in India, and it is a marquee brand, a marquee name that pretty much cuts across all genders, categories, age groups, etc. So coming down to the basic question, Himanshu, at what price does it look attractive, right? That's the question. I remember Page historically, back in its heydays, used to trade at what I think almost 65, 70 times forward earnings. So where are we now? And do you think it's entering attractive price points if someone has a long-term view or not yet?
Yeah, so historically in good times, Page, as you said, has traded as high as 65, 70 times. But that was the time when they used to grow comfortably above 20% with above 20% margins. And that number, I think, is difficult to achieve in the current context. But still, their longer term average has been a 60 times multiple, which I believe can eventually come. Currently, on our estimates, till yesterday, the stock was at 55 times. After the correction today, it is at 50 times. So anyone who's looking to make a comfortable, looking at a 15-20% compounding return, this is a good story. But I think an entry point could be, say, about 10% below current levels, which will be something around 31, 32,000. So a 10% correction from current levels make this a good buy in our view.
Okay, so further 10% correction, and then perhaps the longer term investors can get in. That is the Systematix call. Himanshu, since you track, this entire space, a couple of other retailers as well, basically discretionary stocks, tell us more. I mean, what are the other trends that you picked up? For instance, I remember Aditya Birla Fashion and Retail, the operating performance, the margin picture was really dismal year on year. I mean, they came under a lot of stress. I think even Trent, if I remember correctly, there's some margin compression. So what's going on? What's the pulse of the customer telling you?
Yeah, so different companies are reporting different trends on the growth front. So for Trend, for example, has been seeing the best growth in terms of like-for-like numbers by far. So they are leaving competition far behind on growth. But yeah, one and ABFRL has been quite weak. VMart has been quite weak. So that clearly tells us that broadly demand across the board is slightly on the weaker side. But one common trend across important one is on the margin side. Margins are under pressure for all these retailers across the board. Two or three things are happening. One is most of the companies are having to give more discounts, more promotions, etc., to drive sales to the consumer. The second part is all these guys are seeing much higher sales on the online channel, and online typically is a lower margin channel. So that again is another issue on the margins. And thirdly, we are seeing very aggressive marketing spends from a lot of these retailers. They have not invested behind the brands during the COVID period. Now they are looking to invest aggressively on marketing, branding, coming up with new products. So all of this is basically to support demand in the current slightly sluggish sort of an environment, especially in the smaller cities. So in metros and tier one cities, sitting here in Bombay, we might not maybe realize this sluggishness, but smaller cities, there is clear pressure, and companies are having to spend a lot more to drive the same amount of sales, which is leading to this sharp margin compression that we are sort of seeing here.
Got that. So, all right, Himanshu, then final question. If anybody is looking to allocate some money, let's say from a 1 to 2 year perspective, I'm taking a medium to long term view here. First of all, should they look at any consumer discretionary stocks at all? Because there are other, choices available in the market as well. So, should they look at discretionary? And if yes, then which companies would you go with?
So, to be honest, I don't see any of these discretionary stocks, I mean, giving you very strong returns in the near term. So, next 2, 3 quarters, till this uncertainty remains, I don't see positive triggers for these stocks. But of course, if someone has a 2, 3 year perspective, then the sector leaders in a lot of these discretionary categories, it makes sense to load up on them. Like in paints, you have to go with Asian Paints. In QSR, maybe a Jubilant Foodworks. In footwear, maybe a Metro shoes. So in apparel, Trent is the clear leader, and innerwear again coming back to Page. So the category leaders in all these segments in the longer run should surely do well. Structurally, the stories are intact, but don't expect, I would say, any returns at least for the next 2, 3 quarters. Once we come closer to the festive season, is when we should see a much clear trend as to whether the demand is coming back or not. But as of now, because of the uncertainty, I think it doesn't make sense to go super aggressive as of now.
Okay, all right, got that. Words of caution, and perhaps one that we can take on board absolutely before making that choice with respect to investments. Thank you very much, Himanshu. Very helpful conversation today to sort of get us more clarity on what really is happening with some of these consumer trends. Well, with that, we will thank Himanshu, and we will thank you as well for being with us all through this week. Have a fantastic weekend, and we are going to see you with more interesting market stories come Monday.